we are now joined by Mr. Amit Goel, co-founder and Chief Global Strategist at Pace 360. Good afternoon to you, Amit ji, and a very warm welcome. How are you characterizing the state of play on Dalal Street today?
Shail, a very good afternoon, and thanks for having me on. My understanding is that equity markets have come some distance in the last week to 10 days. And of course, the fact that at least we have got some semblance of peace and stability from Iran and Middle East has played a good factor. And of course, crude oil prices have come down. My understanding is that there is still room for the markets to go up, and uh, I definitely feel that large caps will do very well from this point, because while some of these small cap indices are at all-time highs, and some of the mid cap indices are very close to all-time highs. But if you look at the large cap indices, they are still quite a distance short from their highs that were made in January of this year. And my understanding is that even large cap indices could make new all-time highs. Of course, it will take some time. It will probably take a couple of months for that to happen. But my base case at this point is that Nifty could go all the way up to 27,000, and Bank Nifty could go all the way up to 64,000. And in the meanwhile, small cap and mid caps will continue to do well. But relatively speaking, large caps should do better from this point onwards.
Okay, fair point. So how are you positioning yourself at this point of time? You are primarily a risk taker via the ETF route. What is it in your portfolio so far on Indian equities, and what is the percentage of Indian equities to total portfolio?
Perfect. That is absolutely correct, Shell, that we are at the moment about 55 to 60% in equities, and these are all Indian equities at this point. And you are right about ETFs. Most of this money is invested into ETFs, particularly Bank Nifty ETF is an instrument that we are very heavyweight on at this point, because the price earning ratios are very compelling.
Okay, that's
And
interesting.
I think the story is still pretty good as far as the banking is concerned. And the latest scheme from RBI on the FCNR, that also helps the banks. The rupee having appreciated a little, bond yields having come down a little. All this is a very favorable backdrop for the banks. So we are at the moment about 55 to 60% in equities, and we might even take it up further over the next few days, because we do believe that a goodish 10 to 12% rally is still pretty much on the table. And even though it will take a couple of months for that to happen, so we might take the percentage from 55 to 60% at this point to about maybe 70 odd percent. And then hopefully we want to book our profits sometime in August or sometime before Diwali, where we feel that Indian markets could hit all-time highs even on the large cap indices.
That's a very welcome change in your outlook, Amit. What drove this change of heart?
So basically, we turned bullish in March. So we were quite pessimistic on the markets till about February, not because we knew that tensions are going to come up in the Middle East, but we just found the valuations not very compelling in January and early Feb. So in March, when markets went down a lot, we started buying, and we kept buying between March, April, May, and even June. We have not bought much in the last few days ever since the markets took off on the upside. So the change of heart, basically came from a couple of factors. One, the valuations got a lot more compelling in March. And second, we were absolutely of the view that at some point, this war is going to de escalate and crude oil prices will come down. So it was more a macro call coming from the fact that INR had depreciated a lot, crude oil had gone up a lot, Indian markets had come down a lot, Indian markets had underperformed a lot. And our basic macro understanding is that the world is still pretty much in a good place as of now. And Indian markets having underperformed so much in the last 2 years probably are getting ready for some kind of outperformance. And I'm hoping that outperformance should unfold over the next couple of months. So these were the factors because of which we went up from practically 5% invested in equities to about 55 to 60% at this point. And if we get a correction in the next week to 2 weeks, or maybe 3 weeks, we might increase this stake a little more. But if we do not get a correction, we'll probably just hold on to our existing positions and wait for a far better time to sell and book profits.
Okay. What has this position come up against? Have you reduced your cash, or have you exited from other points of assets? What created this overweight in Indian equities?
Excellent point, Shell. So basically, we had practically nothing in cash in Feb and March. So what we did was that the amount which was invested in corporate bonds, where we were getting a yield of about 10 to 11%, we took money off the table from those corporate
Okay.
bonds because we felt that Indian markets from that point onwards could deliver a lot more than just 10 to 11% annualized return. And so far, that has played out well because on the equity side, we are doing well, and we are up almost 8 to 10% from where we started investing in March. But we still believe that this is not an exit point, and we still believe that there is a better scenario that could play out. And particularly, it could happen once the bulk of the quarterly earnings are behind us, because obviously, this quarterly earnings are going to be a little under the weather because of the influence of high crude oil prices, high logistical costs, and margin pressures. But once the quarterly earnings season is predominantly over, we believe that the outlook is going to look a lot better because going forward, with costs having come down, and margins getting resurrected, we believe that there could be a rally sometime in the next 2 to 3 months, which could take us to all-time highs.
Okay, fair point. That's an interesting point that you make. So, apart from banking, is there anything else that attracts you on the Indian geography?
So we do have some small caps and mid caps, which are basically opportunistic buys that we did because we thought that these particular stocks had very little downside and probably a reasonably good upside in them. And for example, I can tell you about IDFC Bank. I can tell you about Saman Capital, and a few of those kind of stocks we bought. IDFC came down because of the banking, because of that scam which they experienced. So we thought that it was a good entry point. And Saman Capital was available at a massive discount to its book value, and we thought that this discount is going to narrow over a period of time. So, so we just bought some stocks opportunistically, but predominantly it is Bank Nifty, which really appeals to us at this point. we got a great opportunity to buy Bank Nifty because of the fact that yields were going up and inflation was high, and uh, everybody thought that RBI is going to take up the interest rates. We did not believe that RBI would take up the interest rates by 50 basis points over the next 6 to 8 months. And then, of course, the FCNR came along, and that has obviously added to the sentiment. So we are most bullish on Bank Nifty at this point. But of course, opportunistically, we do have some small caps and mid caps where we think that the downsides are still not much, and there could be a goodish 15 to 20% upside from the current levels.
Okay. You are primarily a value buyer or a distress buyer when it comes to equity assets, in the sense that you buy pain. Has IT reached your zone of pain, or is it still a value trap?
Basically, I agree with you that IT at this point is looking somewhat attractive. It's just that the upsides are probably not that promising for us. So I do believe that the downsides on IT, particularly after the fall that happened after Accenture guidance last week, I think that was pretty brutal. And IT index, as your chart is showing, it is just massively down over the last 1 year. But we do have exposure to IT through our investment in Nifty ETFs. But beyond that, at this point, we are not very enthusiastic buyers, even though I completely submit to your point that the downsides are probably not that big because the worst is pretty much discounted. And but it's just that we are quite happy with whatever little exposure that we have to IT at this point through our Nifty holdings.
A view perhaps on gold and silver.
Yeah. So, Shell, gold and silver have obviously underperformed a lot over the last few weeks. And even I did not think, while we did think that when it went up to $90, silver went up to $90 in middle of May, we did think that the upsides are very, very limited from that point. But I did not think that the price would come down to $62, $63 so easily and so fast. I am pretty bullish on silver at this point because the fear readings that we track on silver, which is a Bloomberg proprietary measure, they have hit all-time highs. So, in the sense that the fear is the most intense in silver ever since they started tracking that sentiment indicator about 12 years back. So, it's the worst point in last 12 years. And I do believe that silver could go up back to about $80 over the next month or couple of months. But I don't think that silver is going to go anywhere close to its all-time high that was made in January of this year. And same I can say for gold. So they are opportunistic buys at this point, but nothing more than that. Longer term, we have concerns, and longer term, we still believe that gold and silver are going to make lower lows. And we believe that by 2027 or 28, silver could come down to $30 or lower, and gold could come down to 2,800 to $3,000. But at this point, I think they have just about started a rally. This rally has more to offer, but not that much.
Why would gold and silver correct so substantially?
That's a very, very good question, Shail, and this is somewhere where we are at a divergence compared to pretty much the consensus that appears from experts and economists all over the world. And for this, and the reason is very simple. All of them are looking at a inflationary world economy, while we are looking at a deflationary spiral. Starting from, let's say, it could take a month or two or maybe 3 months for that to get hold, to take a hold. But eventually we believe that we are headed for a deflationary spiral because of the huge amount of debt and because of the disinflationary and deflationary impact of AI. So when that deflationary spiral comes, then gold and silver will also go down, and we believe that that is going to unfold over the next 1 to 2 years. And but apart from that deflationary spiral, I think the sheer enthusiasm, and I might call it madness, that we experienced in January of this year for precious metals, that kind of madness happens just once in a few decades. And whenever that has happened, any point of time in last 500 years, then post that the next 1 to 2 years have been pretty brutal for gold and silver, and I don't think that it would be an exception this time. So 2027 to 2028, you can expect some pretty brutal bottoms in gold and silver. And at that point, maybe gold will become a great long-term asset to buy once again. But at the moment, you can have opportunistic calls where you can make about 10, 12% in a month or two, but nothing beyond that. I would not recommend anybody buying gold and silver from a longer term point of view at this time, but you could buy them from a, let's say, a near term standpoint.
So this deflationary spiral, while the world is globally linked and therefore India would be impacted as well, how are you structuring your long-term portfolios to be that, to benefit from that possible deflation?
That's a great question again. So basically, whenever in the last 200 years we've had a deflationary spiral, and there have been quite a few notable points, even in the last 25 years. So there was a deflationary spiral in 2001-2 when tech bubble burst. There was a deflationary spiral in 2008-9 when GFC struck. There was a deflationary spiral in 2015-16 when China devalued its currency. And there was a short deflationary spiral in 2020 because of COVID. So at all those points, the best performing asset class in the world is long-term sovereign bonds. So we are already holding substantial amounts of US government's 20 and 30-year bonds in our global portfolios. In our Indian portfolios, we've still not started buying Indian 30-year and 40-year government bonds. But I can assure you, Shail, that in the next 2 to 3 months, there would come a point where that would become a very big asset class for us, and we would buy them substantially in our portfolios and in all our products. And my understanding is that the 30-year Indian bond yield, which is at the moment about 7.50%, over the next 2 years, when this deflationary spiral unfolds, this could come down to even 6%. And US 30-year yield, which at the moment is about 4.9%, could come all the way to 2.5 to 2.75% over the next 2 years. So those asset classes are just going to deliver us humongous returns, maybe 15 to 20% CAGR. But of course, you need to buy them at the right point. And then when the deflationary spiral happens, which is a very, very high base case scenario, high probability base case scenario for us, then you need to sell them also at the right point. So we are going to ride this journey, and hopefully we would be able to sort of share this with your audience as and when we sort of navigate this journey.
Fair point. So it's difficult for retail investors to buy Indian sovereign bonds because of the ticket size. So what would you suggest they buy from the mutual fund stable?
Absolutely brilliant question, Shell. So there are plenty of options. For example, there is a fund from Axis, which is a rolled on maturity fund, where it's called Axis Long Bond, if I'm not mistaken. And there are a few funds from HDFC. Then there is one from Bandhan. So there are enough options that we have on funds where the current maturity is pretty long. It is like 30 years or something. So and you could just hold them, and these are, some of them are not actively managed funds, so which means that your expense ratios are very, very modest, and you could just hold them, and you could enjoy those returns. We will share the exact names of those funds maybe in our next conversation, because at the moment I do not have the exact names, but I can safely tell you that there are enough options within
Fair
the
point, fair
mutual
point.
fund in the ETF industry.
Okay, fair point. We'll pause it here, Amit, and I have always believed that gentlemen in the market have always preferred bonds. Let us see how this, really worrisome deflationary spiral comes into being. Be that as it may, it is our job to inform investors, and it is their job to safeguard their financial health. Thank you for being with us. As always, it's such a pleasure.
Thank you so much for the opportunity, Shail. Thank you so much.